As of February 28th, 2020, the Dow Jones Industrial Average has fallen by more than 3,500 points from its recent high close, the largest weekly drop ever. And with that, $3.6 trillion of wealth has been wiped off the board in less than a month. That's right, folks. The recession that we've all feared about for the last 11 years has finally arrived. Or has it? In this video, we're going to take a look at the damage that has been happening to the world's economy by rogue trade deals, deadly pandemic viruses, and market speculation over the last couple of months that has led to the 2020 recession apocalypse. And most importantly, we're going to discuss how it's going to hit you in the wallet. What's up, you guys? You're watching B2B Fusion, where our goal is to inspire you to take action to improve your finances and business using the power of technology. Start by punching the like and subscribe buttons for the YouTube algorithm, and let's dive right in. So stocks, yeah, they've not been doing so well this last week of February 2020, have they? If we take a look at the major indices, we can see that in general, things have not been looking up. The Dow Jones Industrial Average closed 357 points or 1.4% lower on Friday, its 7th day in the red. At its worst on Friday, February 28th, the Dow was down 1,086 points. It dropped 3,583 points this week alone. This would be its worst one-day point drop in history. On a percentage basis, the 27th drop was the worst performance since February 2018 at a 4.4% loss. This last week of February would represent the worst week since October 2008, as the Dow fell 12.4%. The S&P 500, the broadest measure of the stock market, fell 0.8%, its worst weekly percentage drop since October 2008. The sell-off has shaved $3.2 trillion off the S&P 500 this week. It's dropped $3.6 trillion from its February 19th high. And last, and probably least, the Nasdaq Composite has fallen at 10.5% for the week. And it wasn't just stocks either. Crude oil, which is often viewed as a real-time barometer of economic growth, has plunged deeper into a bear market. Oil plunged 4.9% on Friday the 29th at $44.76 a barrel. Now, crude hasn't closed below $46 since December 2018. The commodity is on track for its sharpest weekly decline since 2011. Even gold, which is traditionally a safe haven during the times of market trouble, sold off. A lot of folks are attributing the drop to investors pulling cash out of their gold investments to counter their losing stock investments. Gold futures settled 4.6% down at $1,564.10 an ounce, recording its worst one-day percentage loss since November 2016. Treasury yields slipped further and hit new record lows on Friday as investors piled into the safe haven government bonds, with bond yields and prices moving opposite of each other. The 10-year bond yield dropped below 1.15%. So one of the things about this particular market swoon is that it sort of seemed to come out of nowhere. Just like this request to hit the like button for the YouTube algorithm and to drop a comment with your plan to weather the storm of the 2020 recession apocalypse. But one day, the markets were posting a 1% gain here, a 3% loss there, and then seemingly from out of nowhere, back to back to back, huge loss days. But if you were paying attention, you probably should have seen it coming. Side note, that's true with all recessions and market dips. No one ever sees them coming, ever. And with markets and economies, and really most things in life, 2020 vision only occurs in the rearview mirror. The warning signs for this massive market crash have been building for months now, mostly because of the Dos Equis delirium. The coronavirus. When news of the outbreak from China first hit in December, most people thought it was a minor anomaly. Anomaly. Tough word to say. But as the months wore on, it became more and more obvious that the virus was going to affect the supply chains in China. Supply chains that support economies the world over, including the US. And outbreaks in Italy, South Korea, Japan, and Iran have fueled fears that coronavirus has turned into a global threat that might derail trade and industry. Anxieties intensified late February when the United States reported its first virus case in someone who hadn't traveled abroad or been in contact with anyone who had. This, combined with general uneasiness of trade deals with various countries, China being most prominent, has gotten investors in the mood to sell off their gains from the previous couple of years and flocking to safe havens in bond markets. All of this came to a head for the last week of February 2020 and combined to form a perfect storm of unease combined with capturing of profits. The question then becomes, how does this hit you in the wallet? Well, to answer that, we need to ask 4 additional questions. First question, does this mean that the economy is in a recession? A lot of people conflate a stock market crash with a general economic crash. And frankly, that's always been the case, and the most obvious examples are of the crash of '29 being associated with the Great Depression, the dot-com bubble popping in the late '90s, and the economic recession that occurred around that time. And of course, the 2008 market crash, and the recession and slow and painful recovery that soon followed. But not all stock market crashes have heralded a general economy tanking. A couple of examples would include the 1987 stock market crash, often called Black Monday, with the Dow dropping 20.7%, which was at the time the highest one-day percentage loss in the history of the indices, or the flash crash of May 6, 2010, which resulted in the Dow losing 998 points in just a few minutes. This particular crash was the result of a technical malfunction, and a lot of folks speculate that quant computing traders had a lot to do with it as well. On August 24, 2015, the Dow fell 1,089 points in early trading, a 6.6% decline. The index ended the day down about 588 points. Investors panicked when oil prices dipped below $40 a barrel, causing fears such low prices would reduce earnings for companies that sell oil. More recently, in February 2018, the Dow dropped 2,270.96 points in 3 separate trading days. On February 5th, it lost 1,175.21 points by the end of the day, the biggest point lost in history at the time. It had plummeted $1,600 in intraday trading. By the end of the day, the Dow was down 10.4% from its record close of $26,616.71 on January 26, 2018. The point is, each of those crashes occurred during a time of economic expansion for the general economy, and the economy continued to expand after those crashes had occurred. And investors eventually made their money back if, this is a big if they didn't panic sell and kept in the market on the way up. Now that said, quite a few large market crashes have correlated with larger economic downturns in the economy in general, such as the Great Recession triggered in 2008 by a large market crash, and of course the Great Depression of the 1930s. Now, if an economic report comes out indicating that the economy is indeed in a recession, then that would beg a second question. Are you prepared for the tough times? When times are good and you have a good job and the stock market just seems like it keeps going up and up, it can be tempting to let your lifestyle, and more importantly, your lifestyle's impact on your bank account, go up and up right along with it. But that is actually not the best time to spend all willy-nilly like a drunken sailor, to mix badly dated metaphors. When times are good, generally speaking, it's a good idea to keep your lifestyle costs roughly the same and instead save up for things like your emergency fund, which should be relatively large. By relatively large, different people have different standards for what that means, but a lot of people advocate 3 to 6 months of your needs-based spending. And that spending should be socked away for an emergency, such as an economic recession. Others say it should be a year of your salary. Still, others say 2 years of your salary should be socked away for an emergency, such as an economic recession. I personally don't know what the right answer is, but a decent chunk should be stored away to help you get through the rough times. Should the economy go south and your investments go south for a while, and or your job/customers can no longer afford your services, so to speak. If we are indeed in a recession, that more than likely means that jobs will be pared back for a little while, at least as gross domestic product goes under and people in general tighten their belts. The longer it lasts, the tighter belts will have to become. And that is when your emergency fund will come in handy dandy. And if you've been extra prudent, then the question then becomes, are you in a position to profit? Frankly, me personally, I look forward to times when the stock market goes lower and recessions in general happen, as it's a great time to start looking for opportunities to increase my wealth. A lot of people have said it because it's true. Wealth is built when you buy low and sell high, and prices of various things tend to be lower when recessions happen. As an example, during the 2008 financial crisis, housing prices and real estate in general went through the floor. Plenty of houses were foreclosed upon at pennies on the dollar, and really nice houses could be had for fairly cheap. Once the economy started recovering, so did the prices of those distressed assets, making the people who held them or purchased them quite a bit of coin. Frankly, it's the same with stocks, commodities, and many other asset classes. So if you follow the advice of saving up an emergency fund and having a little nest egg for investing, now might be the time to look into picking up some stocks. At the very least, don't sell out of your positions. Assuming you aren't holding the bag for stores like Sears or Kmart or Toys R Us or anything like that. If those investments really do go to zero, you'll still have lost your money, but more than likely, if you're invested in quality companies, particularly through things like index funds, your investments will rise again. probably in about 2 to 3 months, maybe longer, and this period of time will be a blip in our collective memories. Keep in mind when it comes to investing, it's particularly important to have a sort of contrarian perspective on lots of things. When the crowd is selling, that's a good opportunity to look to buy. When the crowd is buying enthusiastically with no real reason in mind, then it's really time to start moving out of your positions. Unfortunately, that is hard for a lot of people to do, which takes us to our next question. Can you take the emotion out of investing? Taking the emotion out of investing is hard to do for human beings. As you know, we have emotions. It's not hard for professionals and robots to do. Professionals are trained to think rationally and not emotionally, and robots have yet to develop feelings, I think. AI is becoming quite advanced and can probably simulate emotions at this point, which is kind of scary, quite frankly. But even then, it's not being applied to trading algorithms. So if you just don't have the steely-eyed constitution of a Wall Street pro, then do what millions of other people in the US do and just buy index funds. I'd recommend staying away from ETFs as they are more similar to stocks in that they can be traded like stocks during the day, causing you to be more likely to react, like you would if you own stocks, and buy and sell emotionally during dips and run-ups. I have a video on index fund investing that I'll point you to in the description that will help to clear up the mist away from that method of investing. And if you just want a robot and its lack of human emotions to invest for you, you can use a robo-investor like Wealthfront or Betterment or Charles Schwab or any other number of robo-investors out there. Speaking of human emotions, be sure to exercise yours by dropping a comment on how prepared you are to weather the financial storm. And also if you think that this one is the big one, as it were, and a recession is here. And while you're at it, don't forget to subscribe and click the notification bell for more great videos from BTP Fusion. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take action on your finances and business using the power of technology, and we'll see you next time. Peace.